Hello investors, and welcome to another exciting episode of Wealth Nugget. Today, we're opening the door to the world of S&P 500 investment. Often heard but rarely explained, the 500 is more than just a market index. It's a financial powerhouse. This index is like a VIP pass, granting you access to the 500 most influential companies in the United States. From tech titans to retail giants, these industry leaders shape the market, and their collective performance is what the S&P 500 measures. It's a snapshot of America's corporate landscape, a real-time reflection of the country's economic heartbeat. But it's more than just a barometer of business health. It's a dynamic investment platform. By investing in the S&P 500, you're not just buying shares in a single company, but a piece of all 500, like owning a tiny slice of the American economy. Take a peek inside and see why investing here is a game changer. Alright investors, here's the first secret sauce: diversification. Now if you're wondering what diversification is, let's think of it like this. Imagine you're at a buffet. You wouldn't fill your plate with just one kind of food, right? The same principle applies to investing. Diversification is the practice of spreading your investments across various assets to reduce risk. It's the financial equivalent of not putting all your eggs in one basket. Now why is diversification so important? Well, let's say you've invested all your money in a single company. If that company goes under, so does your investment. But if you've distributed your investments across multiple companies, the poor performance of one might be offset by the good performance of others. Diversification therefore helps to smooth out the bumps on your investment journey. And here's where the S&P 500 shines. The S&P 500 is essentially a pre-diversified portfolio. It's a broad-based index that includes 500 of the largest, most established companies in the US. These companies span all sectors of the economy, from technology to healthcare to consumer goods. So, when you invest in the S&P 500, you're not just investing in a single company or industry, you're investing in a slice of the entire US economy. But diversification isn't just about having a mix of different companies, it's also about having a mix of different types of assets. The S&P 500, for instance, includes both growth stocks, which are expected to grow at an above-average rate compared to other stocks, and value stocks, which are considered undervalued compared to their intrinsic value. This mix of growth and value can help to further balance your portfolio and enhance returns. So the next time you're thinking about your investments, remember the buffet analogy. A well-diversified portfolio, like a well-balanced meal, can provide the nutrients your financial health needs to thrive. Let's explore how the S&P 500's diverse lineup can shield you from market storms and keep your portfolio sailing smoothly. Now that we've set the stage, let's talk strategies. Investing is not a one-size-fits-all game. It's a dynamic playground where one strategy may work wonders for one, and may not be as effective for another. That's the beauty of it. It's all about finding what works best for you. Let's talk about dollar cost averaging first. This strategy is about investing a fixed amount of money at regular intervals, regardless of the market conditions. It's like clockwork. The beauty of this approach is that it takes the emotion out of investing. You're not trying to time the market or predict its movements. Instead, you're riding the market waves and, over time, you could potentially lower the average cost per share of your investment. It's a disciplined approach that can help mitigate the risk of market volatility. Now let's switch gears and talk about value investing. This strategy is about finding and investing in companies that you believe are undervalued by the market. It's like hunting for hidden gems. The principle is simple: buy low, sell high. But it's not as easy as it sounds. It requires thorough research and analysis, and a keen understanding of the company's fundamentals. It's a bit like being a detective, delving into balance sheets and income statements to uncover valuable insights. But remember this: no strategy is foolproof. Each comes with its own set of risks and rewards. It's important to assess your financial goals, risk tolerance, and investment horizon before choosing a strategy. And remember to keep your portfolio diversified. It's like having an insurance policy against market uncertainties. You may also want to consider getting professional advice. Financial advisors or robo-advisors can provide personalized investment strategies based on your specific needs and circumstances. They can be a valuable resource in your investment journey. And finally, keep learning. The world of investing is vast and ever-changing. Stay informed, stay updated, and continue to hone your investment skills. We'll break down these strategies, giving you the tools to build a robust investment plan. Let's spice things up with real-life examples. There's nothing quite like a good story to illustrate the potential of S&P 500 investments. Let's dive into the narratives of some successful investors, whose journeys can provide valuable insights and inspiration. Our first tale is of Sarah, a single mother from Chicago. With a modest income, Sarah decided to invest in the S&P 500 through an index fund. She started small, investing $100 a month. Over time, her disciplined approach and the power of compounding turned her modest contributions into a significant nest egg. Today, Sarah is a proud owner of a fully paid-off home and is financially secure, all thanks to her steadfast commitment to investing in the S&P 500. Next, we have the story of the Patel brothers, first-generation immigrants who turned their small family business into a thriving enterprise. They understood the importance of diversification and decided to invest their profits into the S&P 500. This decision not only safeguarded their wealth from business risks, but also multiplied it, proving the power of diversification. Then there's the tale of Robert, a retired Army veteran. Robert started investing in the S&P 500 in his 30s. Despite the various market ups and downs, he stayed the course, maintaining his investments through thick and thin. Now in his 70s, Robert enjoys a comfortable retirement thanks to the returns from his long-term S&P 500 investments. Lastly, we have Maria, a young entrepreneur who believes in the power of dollar-cost averaging. By consistently investing a fixed amount into the S&P 500, regardless of market conditions, Maria has successfully accumulated a significant portfolio, demonstrating the effectiveness of this strategy. These stories highlight the potential of S&P 500 investments. They underscore the importance of patience, discipline, and a long-term perspective. Whether you're a single parent, a business owner, a retired veteran, or a young entrepreneur, the S&P 500 offers opportunities to grow your wealth. Get ready for some eye-opening success stories that will inspire and guide you on your own investment journey. The market is like a roller coaster, and we all love a good thrill. But how do you handle the twists and turns without losing your lunch? Imagine you're on a ship in the middle of a stormy sea. The waves are crashing, the wind is howling, and it feels like you're being tossed about like a rag doll. That's what market volatility can feel like. But just as a seasoned sailor knows how to navigate through a storm, a savvy investor knows how to navigate market volatility. First, let's define market volatility. It's essentially the frequency and degree of price changes in the market. When the market is volatile, prices can fluctuate wildly in a short amount of time. This can be nerve-wracking, but remember, volatility also means opportunity. So how do you sail through these stormy market seas? One way is by sticking to your investment plan. Just as a captain wouldn't abandon his ship at the first sign of a storm, you shouldn't abandon your investment strategy at the first sign of market volatility. Stick to your course, keep your eyes on your long-term financial goals, and don't let short-term market fluctuations throw you off track. Another strategy is to diversify your portfolio. Just as a ship with multiple sails can better navigate a storm, a diversified portfolio can better withstand market volatility. By spreading your investments across a variety of assets, you can reduce your risk and increase your chances of weathering the storm. Finally, consider dollar-cost averaging. This is a method where you consistently invest a fixed dollar amount in the market, whether it's up or down. This can help you avoid the pitfalls of trying to time the market and instead allow you to take advantage of market fluctuations over time. So, while market volatility can be daunting, remember, it's not about avoiding the storm, but learning how to sail through it. Armed with these strategies, you'll be better equipped to navigate market volatility and keep your investment journey on course. We've got strategies to help you navigate market volatility, ensuring you stay cool, calm, and collected when the financial storm hits. Patience is key in the world of investing. It's not about getting rich quick, but about building wealth over time. When it comes to the S&P 500, a long-term perspective can make all the difference. Imagine planting a seed. It doesn't sprout overnight, right? It takes time to grow, just like your investment. And as it grows, it starts to bear fruit. But here's the magic part. The fruit also contains seeds, which can be planted to grow more trees. This is the concept of compounding returns. Your initial investment is the seed. The returns it generates are the fruit, but instead of consuming the fruit, you reinvest it. Over time, the process repeats, and your wealth starts to grow exponentially. So don't be discouraged by short-term market fluctuations. Stay focused on the long game. Think of it as a marathon, not a sprint. We'll unravel the science behind compounding returns and why your future self will thank you for starting today.